The Fed makes another record-breaking increase in interest rates. This might be the last big one for a while. Let's dive in. Today, the Fed made their interest rate policy update. 75 basis points was the increase. Again, same as last month, signaling that this might be the end of these large increases. They're likely going to reduce the pace of increases. They do plan to keep increasing that short-term interest rate. So what is market's response? This is Wednesday, July 27th, and the 10-year Treasury is actually flat right this second. The 10-year Treasury marks longer-term investment horizon, and at 2.78%, it's pretty low compared to even a 2-year is 2.98% right now. That's down today, but it was definitely represents an inverted yield curve. Either a 1-year or 2-year investment in treasuries is going to get you a larger return percentage-wise than you would on a 10-year treasury, which is very, very interesting. The Fed chairman did address a little bit having to do with signals of recession, basically acknowledging that things are starting to slow down, which is exactly what they're out to do. They're trying to slow the economy down. With that, we're going to quickly look at what impacts the mortgages themselves. So consumers are going to take out a loan interest and they're going to pay interest. The investor is going to get a return and they could sell their investment. And when these mortgage-backed securities are created, they're sold onto the market. So the market price, as the market price improves or is green in this case today, that's a positive. That means that mortgage-backed securities are reacting in a positive way to the Fed's announcement today. I think the fact that they're going to slow down the pace of increases recognizes that they've made an impact. The economy is slowing down. And if their goal is a soft landing, it would make sense that they would slowly taper off these increases in the interest rate and wait for the data to come in on inflation. If inflation is not expected to continue at high levels, then we'll see less inflation. So we'll see less of a, we'll see that the Fed will make less moves in the future if they can slow down the pace of inflation. The goal is to get inflation down to 2 to 2.5%. On this chart here, July 6th, we saw basically the highest point that we've seen in the month of July as far as prices. So this was the low point in interest rates. And then as the price declined, the interest rate rose. And that's best represented in the 10-year Treasury as far as the history. That same time period back in June is actually when that peaked. And then at the beginning of July. So with that, biggest updates for now is that it's going to be more data dependent. The Fed is going to make their changes as time goes on, and they're going to likely slow down their pace of increases. And I really do think that acknowledges that the Fed's mission is to keep employment low or unemployment rates low and keep people employed, but also keep the economy moving at a 2.5% GDP growth. So right now we're going to see GDP slowing down a bit because of the Fed's actions, and that's to stifle the inflation. So long-term GDP can still grow and we can still have full employment. So that's the fine line that the Fed walks this week. We'll see you next one.